In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
Well, I don't think that there is anyone in finance that has either had as big of an impact or as beneficial an impact on the world in history than the work that you've done and the work that Vanguard's done. I mean, if you want numbers, you know the numbers better than anyone, but $3.5 trillion under management, the lowest fees really by far in the category, a completely transparent set of tools and solutions that really teach somebody the principles of how to make money and how to think intelligently about investment. Who else has delivered that to that scale in finance in history?
Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings, they pay out dividends, they reinvest the earnings in the business. That's where the value is created. You access that value through investing. So then the question is, corporate America's created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom. That's been the idea from the very beginning of Vanguard, because a mutual company doesn't have a private owner out there or a public owner. And so we have no one to serve but the shareholder.
Throughout life, you'll hear lines like this, and I'd like your quick reaction to each of them. Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with $15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I've put away for them over all these years. And I always put it in balanced index fund. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
40%. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. As stocks will return over the long run, not every 25-year period, but probably 3 out of 4, stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk.
A couple principles of investing question. Warren Buffett at some point has said, it turns out to be true of Motley Fool data as well. Warren Buffett has said that if he had never sold a stock since he was 11 years old, he would be a lot wealthier and Berkshire Hathaway shareholders would be a lot better off. We looked at all of our investment results of the Motley Fool, if we had never recommended a sale, the overall net returns would be better, particularly if you factor in capital gains taxes and the time and energy and emotion of trying to figure out when to sell something and buy something else. Does that align with how you think at Vanguard? Do you think the best thing that somebody could do if they came in at 25 years old with their first Vanguard account in their 401k or in an IRA, if they just bought and said, well, I saw this interview and Jack said I should just never sell that, no matter what happens out there in the world, just keep adding money and never sell is a good principle?
Sure, that's right. Now, you want to be sure you're on a broad-based index fund, and I would say traditional index fund. You can buy a Vanguard ETF, exchange-traded fund, for the S&P 500. It's part of the same identical portfolio, the 500 portfolio we have here, which is largely owned by traditional index fund holders, and to a smaller extent, maybe 20%, owned by exchange-traded fund. Same product, more or less the same price. And if you hang on to it, it doesn't matter which you do.
What I'd like to do is to hear you, if you could give the simplest Vanguard-like, index fund-like financial game plan for somebody who's over 50. Now, of course, each of us has all these individual factors, what decisions we've made, but the average person over 50, how simple? What is the simplest 10-minute solution or half-hour solution to getting Vanguard returns?
Well, I'll give you a simple solution. But the one thing we know about the average is, unlike Wobegon, there are a whole lot of people that are here and here and here, and the average is here. So in essence, nobody's average. You're all a little bit above average or a little bit less than average. You may have greater risk tolerance. You may have greater income requirements. You may have greater financial ambitions and are willing to take risks to accomplish them. But in all those cases, the lower the price you pay for owning the stock market and the bond market, the better off you are. Now, I have talked about a rule of thumb, and I want to underscore it's a rule of thumb, a place to begin thinking about having your bond position equal your age. So when you're 20, you'd be 80% bonds. And that's a rule I would not
80%
dream
stocks.
of 80% stocks. And I wouldn't dream of telling somebody with their first investment to be 80% in stocks. They should be 100% in stock. In the first year, maybe they'll put away $1,000. That's a drop in the bucket compared to the value of their career and the value of what the investments will ultimately be. And by the same token, at least at these interest rate levels, I'll comment on that in a second, I wouldn't dream of telling everybody who was 87.
You say that with pride. You say that with pride and enthusiasm.
To be 87% in bonds. I am not. I'm approximately 50-50. And so a lot depends on your own requirements. And this rule of thumb, first of all, very important for people to think about. And that is just about everybody that you're going to be talking about, every investor you're talking about, also has Social Security. And that has a capitalized value. What is that? The size of that asset pool you would need to create the returns you get in your monthly Social Security check? Probably $350,000. So if you have $700,000 and $350,000 of Social Security, and you put 100% of your stocks into that, so it's $350 in stocks, $350 in this bond-like investment, and you're 50-50. So take that into account.
What do you think can be done to get more women to invest around the world? When you look at most investment companies, when you look at the demographics of brokerage accounts, the first thing you see is that women actually outperform men because for a variety of reasons, but the data seems to suggest that they're trading quite a bit less.
That's exactly correct.
And that's maybe they don't have as big an ego and believe that they can make a better decision next time, or
no, I think it's a matter of women catching up generally with the idea of investing, because the breadwinner has always traditionally been the husband. That's now radically changed. And here at Vanguard, I think roughly 50% of our crew members and 50% of the managers and 50% of the next level up are women. And so the distinction is kind of vanishing. And I think that's good.